Good morning, traders. Welcome to today's morning market call. My name is Ian Joseph, market analyst at HFM, and it is an important day. It being the 13th of February 2026, it is a Friday, so this is the final trading day of this particular week. I would want us to familiarize ourselves with the disclaimer that states the information herein is only meant for educational and informative purposes only. None of it should be construed as investment advice. Trading the financial markets do carry a degree of risk, but do not worry, I'm here to help you and assist you look at the markets the right way. I would want us to, as per the title of this morning market call, what is happening to gold, silver, especially right now, this particular moment in time, and what does this mean for us as traders? How can we capitalize on these opportunities? How can we make use of the probabilities that the markets are presenting to us at the moment? But first, I would want us to talk about the score and draw challenge. It is our time, Africa. Indeed, we do have less than 15 days to the end of the score and draw challenge. It has been ongoing ever since 1st of November. It shall conclude on 28th of February, and one lucky trader is going to drive home with a brand new BMW 4 Series new model. Not only that, two people are going to get a UK Premier League trip, all expenses paid for, including flights, accommodations, and match tickets. For winners, 55-inch TV. 20 winners, official EPL football jerseys of their own choice, and 60 lucky traders are going to be credited $200 each onto their accounts. Keep a keen eye on our social pages. We shall be announcing the lucky draws very soon. I would want to start looking at the economic calendar, whereby during Asian session today we did have a lot of activities happening, starting off with business for New Zealand, where it did come out slightly lesser than anticipated. And we shall look at a chart of USD or NZD USD and look at what the markets are telling us. But currently at the moment, we are seeing the prices rally to the downside. At exactly 5 a.m. in the morning, we did have Reserve Bank of New Zealand releasing its inflation expectations for the first quarter of 2026, whereby we are seeing them look, analysts are looking at a previous number of 2.28%, and we are looking at a forecast of inflation picking to the upper side at 2.37%. Now, if you look at the graph, this is the official document that was released by the Reserve Bank of New Zealand. Looking at the 1 year, which is the pink line, we do anticipate inflation to pick up to 2.59, and we do anticipate 2 years out to come down to 2.37, which is almost at the target range that the central bank would want for them to justify lowering of interest rates. In the next 20 minutes and counting, we do have CPI numbers coming out for the Swiss franc. We are looking at inflation remaining more or less similar to the previous number. This is the year-on-year release at 0.1%, which effectively is going to move prices quite aggressively if the data does come out higher or lower than anticipated. But the highlight of the day is none other than CPI, whereby we have consumer price index coming out in the next 6 hours, 19 minutes, where we would want to pay attention to the year-on-year release up to January. And this is the core CPI, which usually excludes food and energy. Looking at the previous number, it's at 2.6%. We are anticipating inflation to cool down to 2.5%. And this is quite important. Why? Because the data that we are going to receive today could help us understand what is going to happen in the next 33 days when we do have the FOMC meeting. Looking at the statistics, ever since the week did begin, let's reflect on 1 month ago on 13th of January, where the probabilities of having interest rates being held at 350 to 375 basis points was at 72.9% chance. But currently, we are seeing the statistics move further to the upper side. Now, depending on the information that you're going to receive today, this could cement the Fed Reserve potentially holding on to interest rates in the near future. Now, going back to the economic calendar, we are going to anticipate the commitment of traders report being updated today, and the commitment of traders report is very important to us as traders to understand how are institutions positioning themselves. If we look at gold, ever since, and this data shall be updated today before the market does close, and this is the first thing that we are going to start with on Monday's morning market call, whereby from 27th of January till February the 3rd, we did see institutions offloading 24,000 positions on longs, whereas they did add 1,700 short positions. Now, today in the evening, this data is going to be updated once again, but we are seeing institutions offload more positions on gold. When we look at silver metal, this is silver. When you look at under managed money, we did see institutions offload 6,234 net long positions, and they did offload 3,518 short positions, meaning institutions are covering their positions on the silver metal. Now, you can use this information also to look at currencies. Let's take, for example, we do have the Canadian dollar, whereby we are seeing institutions did add more net long positions, whereas at the same time they did offload a lot of short positions, signaling that yes, indeed, institutions are looking at more buying opportunities on the Canadian dollar against selling the Canadian dollar. When we look at the Swiss franc today, we do have a lot of short positions because of their relatively low interest rates, and they did cover a few positions, almost 1,265. Once again, this information is going to be updated today before the market does close, and we will want to keep a keen eye on how institutions are positioning themselves. I would want to switch gears onto the charts, and we would want to start with XAU. USD. What is happening to gold currently at the moment? Now, let's reflect on how the week started till where we are currently at the moment. Now, these lines that I do have on my charts, they do represent session breaks, meaning from one line to the next line on the 1 hour time frame is going to signify 24 hours. Essentially, it's going to be 23 candles because the 24th candle is going to be the next day. This is where the markets did begin. Now, this was 6th, which was last week, Friday, this particular piece of price action here. This was Monday. Look at how Monday did open. Monday gapped to the upper side. We had a correction immediately after, and prices did consolidate towards London session. During New York session, we did see buyers rally the markets to the upper side, but during Asian session of Tuesday, the markets did correct, and we entered an aggressive period of consolidation in the markets. Similar instance to Wednesday, where during Asian session, the markets did consolidate. We did have London session rallying to the upper side, but we had NFP coming out better than anticipated at 130,000 jobs, where the markets did move aggressively to the downside. Now, afterwards, the markets consolidated. But yesterday, at this particular moment in time, which was at 7 p.m. East African time, we had gold moving more than 3.72% to the downside in less than an hour. This is close to 1,880 pips to the downside. Now, there was no geopolitical factor that drove the markets to the downside. There was no news release, but why did we look at gold selling aggressively? And it is because of the chain of events that we have been receiving in the markets, where, first of all, we did have NFP coming out better than anticipated, where the data actually did beat forecast by more than twice. We were anticipating gold to sell off immediately, but after the non-farm payroll, gold did consolidate for the next 24 hours. But out of nowhere, yesterday we did have massive selling, and this is purely mechanical. Why? Because we $5,000, if you can just identify 5,000, this is the 5,000 mark that gold has been finding support ever since the week did begin. Now, this is a psychological level. This is a level whereby we do have a lot of participants willing to execute in the financial marketplace. And when gold started the selling off, it triggered massive automation whereby now positions started to be selling off and institutions did, the algorithms did go onto overdrive whereby they did aggregate in terms of selling. We did see prices move aggressively to the downside, closed almost 50% to the downside, and the entire of New York session, towards the end of New York session, we did see prices close well below the opening price of the particular day. During Asian session today, we did see the markets rally to the upper side. It did go back into a Fibonacci level. We did identify this Fibonacci level from this particular high to the particular low. This was the initial move that triggered the entire event. Prices came back into the 50 to 61.8 region. We did have rejection around the golden retracement region, and currently prices are trading below the 50 mark. During New York session today, we are anticipating CPI numbers, which is inflation, which usually has a lot of volatility in the markets. If the data does come out, if the inflation numbers do come out cooling, it means that the Fed Reserve potentially could hold on to interest rates for further, which means that the dollar would be anticipated to be stronger. Hence, gold prices could potentially move further to the downside. I would want to zoom out my chart and look at next potential targets that gold may be attracted to. And I would want to focus on psychological levels. I would want to pinpoint 4,500, which is a psychological level that we have been seeing in the past react quite aggressively, which is around this particular region here. Let me go to properties, and then let me have it at 4,500. Beautiful. 4,500 is well below where prices is currently at the moment. If you can put it into perspective, this is more than 4,700 pips to the downside. Now, the commitment of traders that we are going to receive today potentially could tell us how institutions have been positioning themselves over the past week, especially seeing this massive correction in the markets. We will want to look at the commitment of traders report. What are they doing currently at the moment? Where we have been seeing, yes, indeed, institutions are offloading positions. And I would also want to go to silver. Look at silver, where silver also did have a massive correction yesterday, where it did tank to the downside. And this was the same piece of price action that we are seeing on gold prices, whereby prices did consolidate ever since Monday, Tuesday, Wednesday. But yesterday, we did break out of the structure that we were looking at on the morning market call. This was a zone that we had identified yesterday. We have a clear breakout to the downside. We are now currently retesting. If prices does trade well below the opening price of this week, which is around, if you can put it into visualization. So this is around $78 an ounce. I will consider looking at prices potentially moving further to the downside to this region that was once support, potentially could act as another level of support in the near future. Now, the trigger that I would want to wait for is the CPI, where the CPI could create the next trigger of prices continuing the massive stuff. This is more than 13% to the downside, close to 1,000 pips from 77 to 66. That's like $10 and being lost on the silver metal, and that is a potential market. Let me zoom out my chart here, where we have been seeing a change of character. Prices making lower lows, lower highs, lower lows, lower highs, and potentially we can see the markets making a new leg further to the downside. If you have any asset that you'll want me to look into, kindly put it in the chat section. Queen, which information are you talking of? Okay, I do believe Wangaya has answered that. So it's the CFTC. So that's where the information comes from. The commitment, the commodities futures. So this is the name. This is an official government website that usually institutions are mandated to update the information on the platform. So the information is usually updated. They do update it every Tuesday, but it is made available to the public on Fridays. So if you want to go to the commitment of traders, then this is where the information is. What made that massive sell on gold last week? Last week or yesterday? I do believe you're talking about yesterday. Yesterday, once again, it's a chain of events that we have been seeing in the markets, whereby it did start, first of all, with the non farm payroll coming out better than anticipated. Now, the markets initially didn't react at that particular moment in time, but that was the first trigger. Now, the second trigger was that we did have Fed speeches that most of these members are looking at holding on to interest rates further where it is currently at the moment. Hence, this could potentially mean the dollar is supposed to strengthen. And I would also want to look at an interesting asset, the 10-year treasuries, where yesterday we did see 10-year treasuries aggressively move to the upper side ever since the opening price of the day till where it did close. It did move more than 0.5% to the upper side. Now, this signals that yes, indeed, investors, institutions, and traders are looking at more opportunities in the treasury markets. Why? Because if the Fed Reserve does hold on to interest rates, the yields are going to be better. We are looking at geopolitical tensions coming down. Now, remember, gold is a safe haven, silver is a safe haven. Usually, institutions rush off to these metals whenever there's uncertainty, whenever there's fear in the markets. But whenever the fear does calm down, we usually see investors, institutions now starting to move onto risk on assets. And what are the risk on assets that you are looking at currently at the moment? The 10-year treasuries could be considered as one. Now, I would also want to look at the dollar index. Okay, Lil Dant wants me to look at GBP, JPY. We are going to look at GJ in the next few. Now, look at the dollar index. Yesterday, when gold was selling off, the dollar index was rising to the upper side. Ever since Asian session today, also, we did see the markets rally aggressively to the upper side, signaling that yes, indeed, the dollar is strengthening currently at the moment. Hence, why we are seeing the metal markets move to the downside. If I can zoom out on my charts, we do have prices respecting the fib level where prices did make aggressive selling towards the end of January, but on 20th of January, we saw a change of character where the market was making lower lows, lower highs, lower lows, lower highs, but we had this massive leg to the upper side, and this was when Trump was releasing his speech. He did have positive remarks about the markets. We did see the markets break the most recent lower high being formed. Prices came back down to a golden retracement region on the Fibonacci, which is in between the 61.8 and the 50 level, and we are seeing prices to continue moving further to the upper side. Potentially, I would want to consider looking at prices, but if we can come back to 97.84 in the near future. Now, if the dollar index continues to rally to the upper side, it means the dollar is strengthening. When I'm looking at gold, I would anticipate XAUUSD to continue moving further to the downside. When I look at XAGUSD, I will consider looking at it moving further to the downside. Lil Dante wants me to look at GBP, JPY. Let's look at the British pound against the Japanese yen. Now, yesterday we did have data coming out for the British pound. It was GDP numbers, which came out actually negative, and we did see the markets react as a result. We are looking at Japanese economy potentially strengthening in the near future as a result of Bank of Japan are anticipated to increase interest rates, and as a result, we are seeing carry trading whereby now the Japanese issued bonds potentially could fetch a higher price in terms of yields and more money. It is going to attract more money into that particular economy. Whereas on the other hand, we did have the Monetary Policy Committee of Britain coming to the table, and we were anticipating a few members. Actually, the statistics did jump up. It's a 9-member committee, and we did see 4 members actually voting to lower rates in the next meeting, which potentially means that if they do lower rates, the British pound is going to be weaker as a result of their gilts fetching a lower price. Which, if I look at a chart, you can't trade all of this information on HFM. If I look at the gilts, now this is UK gilts. This is treasuries. This is basically treasuries offered by the British government. Now, looking at gilts, it has been moving to the downside. If I can switch over to a higher time frame, ever since the year did begin, we did see some sort of buying, but aggressive selling at the moment, and prices are almost exactly at the opening price of the year, signaling that yes, indeed, investors are still taking a cautionary eye on the UK gilts currently at the moment. But if the Bank of England does lower interest rates, we do anticipate gilts to continue moving further to the downside, which potentially is going to weaken prices. How does that affect GBP JPY? If the Japanese yen is going to be stronger, the British pound is anticipated to be weaker, we do anticipate prices to continue moving further to the downside. If you look at this chart on the daily perspective, for the past 1, 2, 3, 4 days, prices has been aggressively moving to the downside. If I can just put it into perspective, from these highs to the lows, prices on GJ has moved more than 630 pips to the downside. This is close to 3% of the total move, considering prices was rallying aggressively to the upper side ever since April of 2025. We are now having a change of character. I will consider looking at prices potentially moving further to the downside if at all we do break 207.629. If inflation cools, doesn't it mean gold rallies and USD weakens? Now, when you're looking at inflation, what is in inflation essentially is the general term, but today we are looking at consumers essentially. Now, if the consumer price index does come out higher than anticipated, it means consumers are spending aggressively. If the Fed Reserve sees people spending too much, they would want to discourage spending and encourage investing. How do they do that? They do increase interest rates. Okay. But if they see inflation cooling down, because they would want to see inflation in between the 2 and 3%, the statistics that we are having currently at the moment, remember right now, what we are looking at is what the Fed Reserve are potentially going to do. We are looking at inflation now, the CPI numbers, excluding food and energy, coming back down. This is what the Fed Reserve would want to see for them to justify, okay, inflation is moving in the right direction. Let's hold prices where it is currently at the moment. But if they see it cooling drastically, then they would want to lower interest rates. Now, depending on the information, yes, if you look at the description here, generally speaking, a high reading is seen as bullish for the dollar, whereas a low reading is seen as bearish, because if people are spending, it means more dollars are in circulation. But if people are spending too much, people are not investing. And the central bank usually wants to find a balance between investing and spending. Now, if we look at this information currently at the moment, we are looking at basically the Fed Reserve holding onto interest rates. We have been looking, now this is CPI. We are going to have also PPI. Now, inflation is a general term, and consumer usually, the CPI has a larger weight in inflation compared to the other data. But once again, you have to look at it over a general scope, whereby the Fed Reserve looks at the CPI, they look at the PPI, they look at the PCE, and they look at the PME also. And once again, the CPI usually has the largest weight in their decision. But currently, at the moment, we are looking at the Fed Reserve currently holding interest rates at 92.1%. Beautiful inquiry. We do have Percy wanting me to look at Euro USD. Now, looking at euro against the dollar on the daily perspective, we did make all-time, not all-time highs, but most recent highs at around 1.20848. Prices did have a correction. The region that was once a resistance came back, was tested as support later, earlier this month, actually, to be exact. We did have signs of buyers driving the markets, but currently we are seeing the markets rally to the downside. Similar thing to what we did see on GBP USD, whereby for the past 4 or 5 days, we have been seeing prices rally to the downside. The dollar is anticipated to strengthen in the near future. Now, currently looking at it at the moment, we do have this region of support that I would want to pay attention to. This is less than 37 pips to the downside at 1.18114. If at all the data that will come out today could potentially be the next trigger in the markets. Once again, we are looking at the Fed Reserve potentially holding onto interest rates. And right now, employment has come out at a better number. We want to look at inflation also. They do want to see inflation come back down below 2% for them to justify cutting interest rates. But if they see inflation sticky, then we would want to see prices. Now, reflecting on the question that Queen did ask about inflation cooling, it is usually a balance of the tone. Right now, we are looking at the tone of the Fed Reserve. What are they potentially saying? Most of the members are looking at holding onto interest rates. If they do hold on to interest rates, we are seeing gilts move to the upper side. If gilts are moving to the upper side, not gilts, sorry. If you're looking at 10-year treasuries moving, if interest rates are being held, 10-year treasuries potentially are going to get a much higher return. Hence, the dollar is anticipated to strengthen as a result. Now, I would want to look at the stock markets. Now, it's usually a very big balance. Fundamentals is a very big book. And when you look at the stock markets yesterday, it did move to the downside. Why? Because investors now are weighing the options between the stock markets and the treasuries currently at the moment. We did see the US 500, this is the S&P 500, rally aggressively to the downside yesterday, considering from the highs to the lows that was made. This was more than 2.16% of its total value. During Asian session today, we are seeing signs of sellers drive the markets further to the downside, but this was a massive correction that we did see on the markets as a result of institutions. Now, okay, if they're investing in the stock markets, they will want to cover these positions and then move to higher yielding assets, which potentially, once again, is the 10-year treasuries on the US markets as a result of the dollar index that we have been seeing the strength in the markets. The stock markets usually move to the downside as a result of institutions positioning themselves. I do believe yesterday we were looking at this region where we had identified the highs and the lows. We did have a clear breakout to the downside, and prices did continue moving aggressively to the downside. I would want to consider looking at the next potential target, which is around 6,750 mark. If I can put it into perspective, this is close to 1.1% to the downside. Depending on the data that is going to come out today, the markets are going to react accordingly. Looking at the Dow Jones Industrial Average, after making all-time highs at 50,000, we did have a period of consolidation, but once again, the mechanical sell-off that we did see today um, did aggressively move further to the downside, and potentially I would want to look at the next region, which is around 48,000 648, if depending on the data that is going to come out today. Now we do have the 200 period moving average currently about to cross over to the 50 period, and prices are trading well below that particular region, signaling that yes, indeed, sellers are really driving the markets further to the downside. Considering Asian session, we didn't have volatility because we are looking at the Dow Jones Industrial Average during New York session today, which we are going to stream the CPI on our socials today. I do believe we are going to be on TikTok. We are going to be on TikTok today, streaming CPI coming out live, and we are going to digest this data as it unfolds. What is happening? If it comes out positive, what will we see in the markets? If it comes out negative, what could we potentially see in the markets? Remember, for us as traders, the main goal of a trader is to react to what the markets are telling us. So once again, we shall be streaming live on TikTok today at HFM Kenya, and we are going to digest this data at a deeper level. I can see there are no more assets you would want me to look into. Trent, thank you for the follow. I would want us to look at the promotions that we do have currently ongoing. We do have the Refer a Friend program, whereby you have an opportunity to get up to a $200 cash reward if you do happen to invite your friends to join HFM. Go over to the HFM bonuses and promotion segment, join the Refer a Friend program. Terms and conditions do apply. We do have the profit leaders currently ongoing. Number one, Shital still remains with $10,758. We do have number two, Gabriel. Oh, actually coming up with 7,860. And then we do have number three, NA, with the 2,862. But we do have stiff competition between number three and number four. Once again, we're going to have a $6,500 prize pool for this competition. Number one is going to take home $5,000. Number two, $1,000. Number three, $500. Looking at the virtual to real demo contest, yesterday the competition was really stiff, but today the tables have turned, whereby we now have Eric Wambugu up 20,297% to the upper side, while Elizabeth has slid down to 12,800 and 91. Once again, for this competition, the demo competition, this is an opportunity for you to trade virtual to real money. Number one is going to take home $500. Number two shall be credited $300. And number three shall be credited $100 onto their trading account. That's going to be it for me. May the pips be with you. I shall see you during New York session once again on TikTok. We shall be streaming on HFM Kenya and HFM East Africa. Stay safe.